Date, January 2024. At first glance, everything looks fine. Home prices are not crashing. News headlines speak in cautious tones rather than panic. Open houses still attract visitors. Real estate agents still smile. If you scroll through listings, you might even think the housing market has found its balance after years of chaos. But something feels off. The surface tells one story: stability, resilience, recovery. Beneath it, however, a quieter narrative is unfolding. A narrative that doesn't show up in headline numbers, but in behavior, hesitation, and subtle shifts in financial pressure. The illusion of stability begins with price stickiness. Sellers are not lowering prices aggressively. Instead, they hold, they wait. Many homeowners locked in extremely low mortgage rates years ago. Selling now means stepping into a much higher rate environment, often doubling monthly payments for the same property value, so they don't sell. This creates an artificial supply shortage. Fewer homes on the market means prices don't fall quickly, and when prices don't fall, it creates the impression that demand is still strong. But this is misleading. Demand hasn't stayed strong, it has been suppressed. Buyers are still there, but they are quieter. Many are priced out, not by home values alone, but by borrowing costs. A home that seemed affordable at 3% interest becomes unreachable at 7%. The monthly payment, not the listing price, is what determines real demand. So what you're seeing is not strength, it's friction. Transactions slow down, fewer deals happen, but because fewer homes are listed, the imbalance hides the slowdown. It's like a market frozen in place rather than moving forward. Another layer of this illusion comes from delayed reactions. Real estate doesn't adjust quickly like stocks. It moves slowly, often lagging behind broader economic shifts. Job markets, inflation, and interest rates change faster than housing can respond. Sellers anchor their expectations to past prices. Buyers anchor their fears to current rates. This mismatch creates a standstill. During this phase, the market feels calm, but it's not healthy, it's stalled. Meanwhile, developers quietly adjust. New construction slows, projects are delayed or cancelled. Builders begin offering incentives instead of lowering prices, free upgrades, rate buydowns, closing cost coverage. These are soft discounts designed to maintain the illusion of price stability. But incentives are signals. They indicate weakening demand without openly admitting it. It's a subtle shift, but an important one. Banks and lenders also start tightening standards, not dramatically, but enough to reduce marginal buyers. Credit becomes slightly harder to access. Again, this doesn't make headlines, but it slowly erodes purchasing power across the market. By the end of early 2024, the housing market appears balanced. Prices are not collapsing, listings are not overflowing, but underneath, activity is thinning out. The system is holding, but only because movement has slowed. And when a market stops moving, pressure begins to build. The cracks don't appear all at once. They emerge quietly, almost invisibly, like stress lines forming beneath a polished surface. By late 2024, the housing market still doesn't look broken, but it no longer feels stable. The first noticeable shift is in time. Homes begin sitting longer on the market. What used to sell in days now takes weeks, sometimes months. Sellers initially resist adjusting expectations. They believe the right buyer will come, but over time, patience turns into urgency. Price reductions start appearing, not dramatic cuts, but incremental ones. A few thousand here, a small percentage there. Individually, they seem insignificant. Collectively, they reveal a pattern. Buyers, on the other hand, grow more cautious. Economic uncertainty plays a role. Even if employment remains relatively stable, the perception of risk increases. People hesitate to take on large financial commitments. A mortgage is not just a purchase, it's a long-term obligation tied to future confidence. When confidence weakens, demand weakens. Another underlying issue is affordability compression. Wages have not kept pace with the combined effect of high home prices and elevated interest rates. Even buyers who qualify for loans feel financially stretched. This leads to a psychological shift from "can I buy" to "should I buy?" That question slows the market more than any policy change. Meanwhile, investors begin stepping back. During previous years, investors played a significant role in driving demand. Rental yields, appreciation expectations, and cheap financing made housing an attractive asset, but higher borrowing costs reduce profitability. At the same time, rental markets begin to soften in certain areas due to increased supply. When investors retreat, a layer of demand disappears. This doesn't cause an immediate crash, but it removes a cushion. At the same time, homeowners face rising hidden pressures. Property taxes adjust upward. Insurance costs increase, especially in regions affected by climate-related risks. Maintenance expenses grow with inflation. For some homeowners, especially those who stretched financially to buy, these costs begin to add strain. Most won't sell immediately, but the margin of comfort narrows. Then comes a subtle but critical shift. Distressed signals increase, even if foreclosures remain low. Maury listings include phrases like "motivated seller," "Maury properties return to the market after failed deals," "Maury buyers back out during financing stages." These are early indicators of stress, not collapse, but instability. Banks observing these trends become more conservative. Loan approvals take longer, requirements become stricter, risk tolerance decreases. Again, this doesn't make headlines, but it further reduces market liquidity. By the end of 2024, the housing market still avoids dramatic headlines. There is no sudden crash, no single event triggering panic. Instead, there is a slow weakening. The kind that doesn't shock, but accumulates. And that accumulation matters more than any single moment. By mid-2025, the story becomes harder to ignore. Not because something dramatic has happened, but because nothing has improved. The housing market is still standing. Prices, in many areas, remain relatively high, but the underlying structure has weakened enough that stability now feels fragile rather than reassuring. The biggest shift is in seller psychology. For a long time, sellers believed they could wait for better buyers, wait for lower interest rates, wait for conditions to improve. But waiting has a cost. Life events, job changes, relocations, financial needs, forced decisions. Sellers who once held firm begin to accept reality. Price reductions become more meaningful. Negotiations become more flexible. This is when price discovery begins. Not through sudden drops, but through repeated adjustments across many listings. Each small reduction contributes to a broader trend. Buyers notice. And when buyers sense that prices might fall further, they hesitate even more. This creates a feedback loop. Falling confidence leads to lower demand, which leads to more price adjustments. At the same time, inventory slowly increases. Not because of a surge in new construction, but because homes are taking longer to sell. Listings accumulate. Supply grows, not from new entries alone, but from slower exits. This shifts the balance. A market that once favored sellers becomes more neutral, then gradually tilts toward buyers. But even buyers are cautious. High borrowing costs still limit purchasing power. Economic uncertainty continues to influence decisions. Many buyers adopt a wait-and-see approach, expecting better opportunities later. This behavior slows recovery. Another critical factor is financial fatigue. Households that stretch to buy during peak periods begin to feel the weight of their decisions. Even if they are not defaulting, they reduce spending elsewhere. This has broader economic implications, feeding back into overall market sentiment. Real estate does not exist in isolation. It reflects and influences the wider economy. When housing weakens beneath the surface, it often signals deeper structural adjustments. By mid-2025, the illusion of stability is still partially intact, but increasingly transparent. Analysts begin to acknowledge what was previously subtle. The market is not crashing, but it is not strong either. It is adjusting, slowly, unevenly, and quietly. And sometimes, that kind of adjustment is more significant than a sudden collapse. Because it reshapes expectations. It changes behavior. And it redefines what normal looks like.